Hello guys, what's up? So today we're going to be looking at monitoring and controlling of financial statements. Alrighty. Now, what is monitoring and controlling? Well, it basically refers to kind of measuring business performance. Because what's monitoring? Monitoring is measuring the business performance, and controlling is then taking corrective measures to actually kind of achieve the business's objectives if it's not going in that way. So, monitoring and controlling is essential for maintaining business viability and affects all operations. Okay, now the main ways that we can both monitor and control financial management of the business, because this monitoring and controlling process is there for each of the main key business functions. But how do we do it for the main one, for the finance one, which is what we want now? Well, there are three main ways we can do that. One is through a cash flow statement. Cash flow. Two is through something called an income statement. Income, cash flow, and finally we have this thing called balance. Did we get all of that on screen? Oh, beautiful. So these are the three ways you can actually monitor and control a business's financial management. Now, once again, let me tell it to you why we need to monitor. All right. Sorry, I'm just going to be very casual here. But okay, once again, why do we need to engage in this process of monitoring and controlling? Well, basically, monitoring is when you monitor your First, you set KPIs. You want the business to do something. In the finance sense, they want to achieve this. PLEGS. Right? You'll agree. All businesses want to achieve their 5 main business objectives: profitability, solvency, something I forgot, growth, and solvency, efficiency. So, in order to achieve that, we need to first monitor and control our process. And one way that we can monitor to identify causes why we're not able to achieve it, or why we're not able to achieve it efficiently, and controlling, well, taking corrective measure. Now, what is inside a cash flow statement? Because we've identified, okay, you can monitor and control business financial statements in these three ways. But how can we do, what is each of these statements? What is a cash flow statement? Let me define it to you. So cash flow statement. So first let's define what a cash flow is. A cash flow refers to cash inflows and outflows for a business over a specific period of time. So this cash flow statement, when you add the statement, it refers to the payments and receipts. So it just refers to the cash payments that's going out and cash receipts that are coming into the business over a specified period of time. That is what a cash flow statement is. Alrighty, we've got the definition out of the way. What's a payment? Well, these are quite simple. Cash flow statement refers to the cash receipts and cash payments regarding a transaction over a specific period of time. Receipts are when we get it in. When we purchase, so the receipts are when we get it in, money that's coming to us. Payments, as it suggests, is money that's going out. So that's just a cash flow statement. That's what cash flow statement is showing us. Now, okay, we got that out of the way. Who wants to use a cash flow statement, really? Well, users of cash flow statement include people like owners, maybe investors. See, that's supposed to be a suitcase, guys. Owners, maybe investors. So owners, investors. Who else can be using a cash flow statement? Owners, investors, even shareholders and stakeholders. Shareholders. Okay? Let's just leave it there. So these guys want to use a cash flow statement. Why? To assess a business's ability to manage its cash. So that's what a cash flow statement really tells a business. It'll allow all these other external factors to assess a business's ability to manage its cash. Okay, that's what a cash flow statement is. So it's used by all these guys. And what does the cash flow statement show in the end? Well, it's what is it showing these guys? Well, it's showing if the business is able to generate positive cash flow, positive, could be negative cash flow, and it's also showing whether the business is, what does a cash flow statement show? Whether it's able to generate positive cash flow, yes. Whether the business is able to meet their financial obligations, financial obligations in the short term. Okay, so that's what a cash flow statement is showing you, whether the business is able to meet their financial obligations. Okay, so let me go through, okay, let me just finish it and I'll go through just this section again for you guys. Now, what is in a cash flow statement? Well, cash flow statements, we have three main things. We have these things called, what do you call, activities. That's how it's structured. We have operating activities, we have investing activities, and we have financial activities. Okay, these are all activities. So we have all these. Now, what are each of them? Okay, I'll just go through them with you for you guys. Operating activities are activities that are relating to the main function of the business. So this includes stuff like the sales, so the selling of the product, how much the product costed, selling the product. So things like operating activities. Now, the advertising. In order to create the product, you're paying wages to the employees. All that comes under active. So it's the main activity of the business. Now, investing activities refer to, what do you call, not kind of investments, but mainly non-current assets. Non-current assets refers to investment in non-current assets. That is how I remember it. Let me look at the definition. Cash inflows and outflows relating to the purchase and sale of a non-current asset and investments. Okay, so what are examples of these? Well, these can include stuff like land, machinery, all these kinds of things. Motor vehicle, blah blah. So if you sell a motor vehicle, cash is coming in. So these are all cash inflows and outflows. So that's how it's split. You know how the definition of a cash flow statement is cash inflow and outflow? That's how we're linking to it now. So basically you have these three types. And then financials, what does financial activities refer to? Well, it refers to this one. So bring this definition down here. Refers to the cash inflows and outflows of a business's borrowing activities. Borrowing now, what's something that the business borrows that's coming in? Well, obviously that's borrowing money from the bank. So loans. So loans is obviously a cash receipt, and a cash payment can include interest repayments. So interest on principal that is going out. Okay. What are other examples of financing activities? They can also include stuff like dividends, drawings, all that. Cool. Pretty cool. Now we're ready to move on to the next part. But I just want to recap this with you guys. So, what is a cash flow statement? Okay, let's go from the start. I'll close my eyes and I'll try to recollect it with you guys. So, cash flow statement refers, what's a cash flow first? Cash flow refers to the cash in and cash out resulting from transactions over a specific period of time. So in that sense, cash flow statements refers to the cash receipts and cash payments resulting from a transaction over a period of time. Okay, good job. Now, that's what a cash flow statement is. Now, who are interested in a cash flow statement and why? Who are interested in cash flow statements includes people like creditors, investors, owners, and shareholders. These guys are interested. Okay. These guys are all interested in what? Why do they want this cash flow statement? Well, they want it to mainly assess the business's ability to manage their cash, because that's what a cash flow statement indicates. You can research into how one put it down in the comments, how it can indicate, but that's what a cash flow statement indicates. Now, what else does it help these guys? Well, it helps them assess if they have a positive cash flow or negative cash flow. So it's helping them kind of analyze that bit. And then it also allows these creditors and everyone to kind of actually see if they can meet their financial obligations. Alrighty? So that's what cash flow statements really show. And then we just know that there are three types of activities that are operating, investing, and financial. Operating refers to the main activity of the business. Financial refers to the borrowing activities of the business, and investing refers to investments made by the business and the selling and getting back of non-current assets. Inflows and outflows resulting from them. So that's just cash flow statement briefed down. Okay, easy. Now, let's look at those income statements, fish. Okay. So what is an income statement? So an income statement refers to the revenue earned. Okay, income statement refers to the revenue earned and expenses incurred over a specific period of time. Let me check if the definition is actually right. Because I have the book right here. So income statement refers to the income earned and the expenses incurred over a period of trading. Wonderful. Exactly. So it helps users of information see exactly how much money has come into the business as money, how much has gone out as expenditure, and how much has been derived as profit. Okay, easy. Now, this is easy. Now, the income statement really shows two things: the operating income and the operating expenses. What's the operating income? So the operating income is just income earned from the main function of the business as before. So these are selling of inventories, services, non-operational revenue, blah blah. And operating expenses are stuff like purchasing inventories, payments of services, blah blah. But you're not really going to be using this anymore, so don't stress too much about that. And let's get into income statements. Breathe in, breathe out. Now, as I was saying before, what's an income statement? Income statement refers to the revenue earned and expenses incurred by a business over a specific period of trading. So it's a specified period of time. These both are specific periods of time, and a balance sheet is like a snapshot. It's like at that particular moment. So an income statement, we've defined that. Okay, all well and games. Now, who wants an income statement? I would say these same guys want an income statement, and these are the guys interested. But let's look at more of the other question. Why do they want the income statement? Well, I will explain it now, but then it won't make sense to you here. They want an income statement because an income statement can really it can highlight to these guys the operational efficiency of the business. Operational efficiency. And it can also highlight operational efficiency and whether other expenses are too high and to take corrective measure. Okay, so an income statement, well, it can identify whether operational efficiency is good, bad, and whether other expenses are too high and corrective measure needs to be taken. Now, how can they do this? That's a good question, and I'll just answer it here. This is from gross profit, and this is from net profit. Now, you might be wondering, what are all these new terms? But I'll go through that. GP. So what's gross profit? Gross profit is basically a total sales minus COGS. Okay, now you're like, oh, what's COGS? COGS is basically your opening inventory. So how much you have before you start the financial period, plus purchases, how much you purchase, minus your closing inventory. Because your opening stock plus purchases is how much you have. And then let's say if you didn't sell some, that's your closing stock and you subtract it from here. So that's your COGS. Okay, COGS is just cost of goods sold. It's costs that are directly attributed It's the value of stock that a business sells to its customers. So that's what COGS is. And gross profit, well, it's sales minus COGS. It's part profit. So it's basically business's profit that's representing the operating income minus the cost of goods sold. Okay. Now, you might be wondering, at this point, I'll just go on write net profit too. Net profit's basically this GP minus other expenses. And at this point, you're like, what are these other expenses? Well, these other expenses include things like three types of expenses there are: selling, administrative, and finance. Okay, easy. So these are the three types of expenses. What are inside each of those? I'll explain. Selling expenses are expenses that can be directly attributed to the sales of the good. So these include things like advertising, specifically, of course, that's related to selling of the thing. They can also include stuff like maybe telephone if you want it. Selling can include, advertising, telephone, wages. I would put wages down. Wages, salaries, commissions, anything that's related directly to the selling of the good or service. And then administrative refers to the general running of the business. General running. So these are stuff like, stationery, rent, maybe machinery, telephones, all that. Just the general running of the businesses. And then finally, we have things called finance. Finance is, or as the name suggests, interest payments. The finance expenses refers to like interest payments, loan repayments, dividend payments, all that goodies. Okay, so these are the types of other expenses. When we subtract the other expenses from your gross profit, you get the net profit before tax. So that's how much the business has actually made before tax. And then let's say tax is 30% of the country for the business, take 30% off, and that's how much the business actually has at the end of the trading period. So cool. But now we got to touch back on these 2 points. How does it operate operational efficiency, and how does it highlight that other expenses are too high? Well, look, gross profit, right? What's gross profit? So basically, once you've gotten, let's say you have $100 of sales. Let's not make it too big. Yeah, let's say it's $10 of sales. Okay, if you made $10 of sales, and then your gross profit is the profit that is minus COGS. So let's say you bought inventories for $5. Okay, if you bought inventories for $5, then your gross profit is this 10 minus 5. Okay, so GP is equal to $5. So it's basically showing you that you've sold it for $10, but the cost to make that particular good was $1. Okay, was $5. So that means you have $5 gross profit remaining. Because what's gross profit again? It's gross profit's basically the profit that is there after COGS, and COGS is just cost of goods sold, so it's directly attributed. So COGS only includes stuff like the wages included to make that product, and the product itself. So that's $5. So after that, you get $5. So this is highlighting, if this price is suppose $7, right? It's highlighting that either your operational efficiency is down, that it's taking too much money to produce the good, therefore you need to reduce it down, maybe like bring in machinery, capital labor substitution, maybe do that, who knows. Or it's suggesting that you might need to sell more. But that's gross profit. That's how it's highlighting operational efficiency. Because if the cost is too high here, if your cost of goods is too high, then and your pricing it's that low, you're not really making a profit. That's how it highlights operational efficiency. So income statements obviously gonna highlight the operational efficiency from the gross profit. And then from the net profit, say your other expenses were like $3. Okay, what are these other expenses? Say $1 for advertisement, say $1 for a pen, and $1 for a loan that you took. So these are your other payments, or maybe interest, even interest. Okay, so then the business has $2 left. That is net profit. And what does this net profit represent? This net profit represents that, okay, if this figure is too high, let's say if this figure instead of 3 is like 13, it's representing that your other expenses are way too high, brother. Okay, so you need to then go on. It's highlighting that, right? If you didn't do this, you wouldn't know. But now it's clearly standing out. Oh, I'm losing my money because, my other expenses, I'm wasting too much on advertising. I need to cut down on advertising. So once you've known the root cause, once you've identified the problem, once you've monitored and identified, then you can go on and take corrective measure to actually fix it. And that is what this whole point is. Okay? Easy. So now that I've told you that, does it make sense that what is income statement? So let's go from the start. What is an income statement? Income statements basically, let's go fast. What's an income statement? Income statement measures the revenue earned and the expenses incurred over a specific period of trading. Okay, beautiful. Now, what does an income statement show? What is the purpose? Well, the income statement can highlight the operating efficiency of the business from the gross profit. If gross profit is too high, then business might need to lower costs. If gross profit is too low, then the business might need to venture into other avenues. Now, what is the other expenses? The second point mean? The second point is just tackling on net profit, because when you're talking about income statements, you just want to have the stew in your brain: gross profit, net profit. So now you've said gross profit, okay, it highlights the operational efficiency. Then you got to obviously talk about the net profit. What effect does it have on the net profit? Well, the income statement highlights whether other expenses are too high. From then, the managers can go on and take corrective measure to achieve the business's financial objectives, because that is what they eventually want to do. They can go on, take corrective measure. Why are they taking this corrective measure? To achieve the business's objectives of the plagues: the profitability, liquidity, efficiency, growth, and solvency. That's what they want to be achieving. These are the other expenses. Did I miss anything out? Easy. No, looks like I didn't. So with that, we can move on to balance sheets. Now, when we talk about balance sheet, there is this one really important formula. That is A is equal to L plus OE. Okay. Assets equal to liabilities plus owner's equity. Now, what does this statement mean? Well, it's just saying that the business's total assets, so both current and non-current. So let's write that down. Current assets and non-current assets should equal to current liabilities, non-current liabilities plus owner's equity. It's saying these both are equal. And I'd say a better way of thinking about this that recently struck my mind is that, what are your assets? Assets are any items of value that is owned by a business. So assets are items that's owned by the business. So everything the business owns, everything that the business owns is equal to either money borrowed from outside the business, because you need money to purchase the assets. Nothing is free. Money from outside business plus either the money, such as capital or retained profit, from inside the business. Money invested by the importer, by the owner. So this is a good way of thinking about it. It changed my perspective on balance sheets forever, really. But what is a balance sheet? So balance sheet is basically a summary. A balance sheet is a summary of the business's assets and liabilities at a given point in time. Okay, it's at a given point in time. That's a difference. These are over a period of time at a given point in time. That's a balance sheet. Now, assets are items of value owned by a business. Liabilities are items of debt owed to outside parties. Debtors are, people that owe business money. Creditors are the people who business has to pay. Just clearing that out. And owner's equity is the net worth of the business. So it refers to the funds contributed by the business, i.e., it represents the net worth of the business. Simple, easy, and let's just get going. What does a balance sheet indicate? Well, a balance sheet can indicate whether the businesses can pay its current liabilities with the current assets. So whether the business has enough assets to cover its its debts, and whether the assets of the business are being used to maximize sales, and whether the owners are making a good return on investment. So that's what the balance sheet highlights. So let me repeat it. It's easy. Just think about it logically. Balance sheet, okay. We have assets, liabilities, owner's equity. What does it give these investors? What does it show them? Well, it's showing them, one, write this first, it can indicate whether owners are making good return on their investment. What else can the balance sheet kind of show? But yeah, one, it's showing whether the owners are making a good return on investment, but then it's also going to show whether the business is able to pay its debts in the short term, whether the business has enough assets to pay its debts, whether the business has enough assets to pay debts, and that's about it. Whether the assets of the business are being used to maximize sales. Okay. That. Okay. And then with that, guys, we're really done. That which I mentioned here is the accounting principle. It shows the relationship between the assets, liabilities, and owner's equity. And okay, easy, we're done. We are basically done. So let me just explain this all to you guys one more time. Quickly though. I won't take much time. Stand up. Sorry for that. Okay. 3, 2, 1. We're going to speed run this, okay? So, what is monitoring and controlling? Well, businesses want to monitor and control the financial management of the business. Why? Because it's a vital tool to assess whether the business is able to meet its financial objectives. Easy. How can a business monitor and control its objectives? Well, a business can monitor and control its financial objectives in finance by using these three statements, which are the cash flow, income, balance sheet. Easy. Now, what is a cash flow statement? Go on. You know what a cash flow is. It refers to the cash coming in and cash going out of the business. So cash flow statement is the exact same. It refers to the cash receipts and the cash payments regarding a transaction over a period of time. So that's what a cash flow statement is. And you're like, bam, boom, got 1 point. That's what we're going to be doing it now, boys. We're just going to be ticking. We're going to be getting points. Bam, boom. We got 1 point. Now, who are interested in a cash flow statement? Well, people involved parties who include people like investors, shareholders, shareholders, and owners. So investors, shareholders, and owners might be are able to assess a business. And what are they able to assess? They're able to assess the business's ability to manage its cash. That's why they're important. That's why they want. That's what they want. They're able to assess the business's ability to manage its cash. How can they do it? You find it out on their own. But what else does it show? What else does a balance, like a cash flow statement, show? Why make one? Well, it can, what do you call it? Of course, assess a business's ability to pay cash, manage its cash. But then a balance, like a cash flow statement, can also indicate whether the business is generating positive cash flow. So if the cash flow is volatile, it indicates potential risk. And it can also, tell the business whether they can meet their financial obligations in the short term, whether their business is able to meet its financial obligations in the short term. So yeah, whether it's able to meet the financial obligations as they fall due. Okay, because if they have sufficient cash, well, then you can meet your financial obligations as they fall there, can't you? But basically, a cash flow statement is a mix of both the income statement and balance sheet, because you take stuff from both here and then you put it here. Because what does it include? Cash flow statement includes things like, these are all tick, tick, tick. So cash flow statement includes things like operating activities, investing activities, and financial activities. What's operating activities? Operating activities refer to the main, refer to the cash inflows and outflows relating to the main activities of the business. So what are these main activities of the business? It's mainly involved in the core business function. So these can include wages, salaries. They can also include advertising, anything that is related to the main activity of the business. So selling, of course, the raw material prices, all that. So if I was to just double check for you guys, yeah, it can include the sales that are coming in. Always think about these in this way: inflow, outflow. One inflow, one outflow. One inflow, operating activity, or the sales. One outflow, that's going out, payment to supplier, payment to suppliers, payment rent to bank, employees. Okay, advertising, insurance. We were all right there. Investing refers to the cash inflows and outflows relating to the sale of non-current asset and other investments. Okay, non-current assets. What are non-current assets? Things that you can't, quickly convert into cash. Assets that can't be converted into cash within a year. Assets intended for long-term use, for long-term yields. Yeah, investments. Yeah, that can also include take. And then finally, we have financials. Financial activities include, cash inflows and outflows relating to the borrowing activities of the business. So borrowing now, what's a cash inflow that's coming in? Well, the inflow is when you borrow money. That's an inflow because it's coming into the business. And outflow can include interest payments, dividends, all that. Okay, cash inflows, yeah, can relate to equity or it can relate to debt, loans from banks and financial institutions. Take. So finally, before we go, I want to basically cover this up for you guys and then ask you one thing. What does a cash flow statement show? Cash flow statement can show the main guys, like the investors, owners, and shareholders, the business's ability to manage its cash. But then additionally, the cash flow statement can also highlight whether the business is able to meet its financial obligations as they fall due. Cash flow statement can do that. And a cash flow statement can also, give information about whether the business is generating positive cash flow or negative cash flow. That's what a cash flow statement is showing us. Easy, go, done. Tick, 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 tick. What is an income statement? Income statement refers to the income earned and expenses incurred over a specific period of time. Okay, for a specific period of time. Easy, that's an income statement definition done. What is an income statement show? An income statement can highlight the business's operating efficiency from the gross profit and can also highlight if other expenses are too high and how corrective measure can be, and then corrective measure would be needed to be taken in order to achieve the business's financial objectives of liquidity, growth, efficiency, solvency, and profitability. Easy, go. So we're like tick, tick, tick. Now, what's gross profit? Gross profit is just sales minus COGS. Simple. What's COGS? Cost of goods sold. What is it? What is the actual definition? Well, it's cost that can be directly attributed to the sale of the goods. So it's how much the business has sold. How much the business. So the value of the stock that the business has sold to customers. That's COGS. Cost is just the value of the stock the business has sold to customers. Okay, so COGS you can get it by opening purchases plus purchases minus closing stock. That's COGS. And then we have net profit. Net profit includes things like gross profit minus this one, GP minus other expenses. What are your other expenses? Your other expenses here include things like selling, administrative and finance. So these are your other expenses: selling, administrative, and finance. What is selling? Easy, let's go. Selling relates to the anything that's relating to the main activities of the business. So cost related directly to the sales of the business. So these can include salaries. They can include also like wages. They can also include like advertising, all those good stuff. Okay. Delivery, other on top if you want. What is administrative? Administrative refers to the costs that are directly attributed to the general day-to-day working of the business, day-to-day running of the business. Okay, so administrative costs include stuff like stationary equipments, maybe even rent, land. That will come under here. This will be finances like loans, interest, dividends, all that. But administrative will just be like telephone, stationery. Would a car come here? Would a vehicle come here? I don't know. Insurance maybe. But it's just cost related to the general running of the business. So rent. Of course, rent comes here. Wonderful. And then here goes finance, loan, interest, and dividends. So interest payments, dividends, yeah, easy, wonderful. These are just costs that are associated with borrowing money. Finance costs associated with borrowing money. Even here are costs with the borrowing activities of the business, so the borrowing money from outside. Okay, easy. So we got it. So we got the advantages, we know. So now let's close it again and let's see what can an income statement show. Well, what's the purpose of an income statement? The purpose of an income statement is to, can we say the definition? I don't know. The purpose of the income statement is to highlight the operating efficiency of the business and to help identify if other expenses are too high so that the business can take corrective measure and can achieve the business's objectives. So easy. That is the purpose. Then we have balance sheets. What is a balance sheet? Balance sheet refers to a summary of the business's assets and liabilities at a given point in time. So beautiful, bam, bam. What are assets? Let's go here. What are assets? Assets relate to the any items of value owned by the business. Liabilities are money that is owed to outside parties. So items of debt owed to outside parties. And then owner's equity is funds contributed by the owner, so capital contributed by the owner, or it will also include certain profits, but it represents the net worth of the business. Okay, beautiful. Now that we got all this, let's look at the accounting principle, which is just A is equal to L plus OE. Assets equal to liabilities plus owner's equity. So what is it saying? It's saying that everything that the business owns is equal to either the money that you borrowed from the outside parties or money that's invested by the owner, so capital invested by the owner, or maybe even the take profit from the owner. So that's what it's saying. That's how the balance sheet would actually just look. Current assets, non-current assets, current liabilities, non-current liabilities, owner's equity. What are current assets? Current assets are assets that can be turned into cash within 1 year. So items that can be turned into cash within 12 months. Non-current assets, assets that have an expected life of longer than 12 months. Okay, so these include like buildings, machinery, your land, all that. Buildings, machinery, land. And then your current assets include things like what you're going to turn into cash within 12 months. So these include, of course, your cash, your inventories, your accounts receivables, money that's coming in, all that goodies. What are current liabilities? Current liabilities are, liabilities that is owed to outside parties. So current liabilities is liabilities that the business has to pay within 12 months time within the short frame. So items of debt owed. So those debt which have to be repaid in less than 12 months. What are these? These are short-term debt. Remember, short-term. So you can write any of the short-term debt. So you can write commercial bills or you can even write overdrafts. And then non-current assets are items of debt that have to be repaid after 12 months. It can be repaid, like they can be repaid longer items of debt. So debentures, unsecured notes, all that, all those goodies. Mortgages, of course. How did I forget mortgages? Owner's equity, capital invested by the owner, retained profit. Easy money. Now, what does the balance sheet highlight? After seeing all this, it should be easy to see that the balance sheet highlights the business's the bill highlights the whether the owners are making good return on investment. Of course, that's easy to identify because we can just rearrange this principle that OE is assets minus liability, so that's how much owner's equity. So the balance sheet can help indicate the balance sheet can indicate whether the owners are making a good return on their investment. So owners and shareholders, of course, and it can also influence others, and it can also indicate whether the business is able to if the business has enough assets to meet its current obligations, its current debts. Okay, easy, beautiful, and we are done. Tick, 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 tick. Thank you for watching.